Okay, continuing on with our discussion of beneficiaries. As I just described, there's the primary beneficiary, okay? And then people, when you take out any type of financial product, you should, in addition to naming a primary beneficiary, you should always name a contingent beneficiary, okay? So a contingent beneficiary is entitled to the proceeds, in this case of an insurance policy, if the primary beneficiary dies before the insured dies. So let's say that I own a policy, I am the insured, my wife is the primary beneficiary, and my wife dies before I do. I need to have a backup plan for my beneficiaries. In this case, for me, it would be my children, and so I would name my children as the contingent beneficiary. Now, if my children are not of legal age, when I die, so my wife dies first, my children move from being the contingent beneficiaries to the primary beneficiaries of the policy, then I die. My children are not of legal age, 18 or 21, depending on what state you're in, okay? Then they must have a guardian, a legal guardian, or a trustee to oversee the proceeds of the death benefit, okay? Someone has to be responsible for the money. All right, something to be mindful of, and this is a question that's asked in a lot of exams. Excuse me, if an estate is named as the beneficiary of a life insurance policy, then the death benefit proceeds may be subject to estate taxes and to the claims that creditors have against the estate. So you need to work with an accountant or a tax attorney to make sure that the proceeds are protected from taxation, protected from creditors, people who the estate owes money to, who the owner of the policy or the owner of the estate might have borrowed money, might have owed money to creditors. If the death benefits feed into an estate, you have to make sure that the benefits feed in properly. Otherwise, the benefits, as you know, death benefits that are received by an individual are not taxable. But if they're received by an estate, that's what this is talking about, they could be. So you've got to be very careful with that. All right? So there are two kinds of listing that a benefit that can be made for a beneficiary. One is a revocable beneficiary, and that means that the policy owner, okay, reserves the right to change the beneficiary designation at any point, okay? And the policy owner does not have to consult with the current designated beneficiary in order to make the change. And that is really the preferred method of naming a beneficiary. Then you have the irrevocable beneficiary, and this is a beneficiary who must be consulted by the policy owner and must consent for the policy owner to change who the designated beneficiary is. So this can be a very dangerous thing, so you have to be real mindful and thoughtful when you decide whether to name a beneficiary a revocable beneficiary or an irrevocable beneficiary. All right, so you have to be, once again, you have to be mindful, you have to be careful. When you name a beneficiary, you need to be very specific with identifying who the beneficiaries are, because there's this thing known as a class beneficiary, and that is when you name a group such as children. My children are the beneficiaries. You need to be careful who might be considered to be a child, because if you have a mixed family, you have to be careful and you have to be intentional when you identify who the members of the class are going to be, because those are the people that are going to get the death proceeds. All right. Many plans have, policies have what are called an exchange of plan provision, and this allows policy owners to exchange their present policies for different contracts. So you can start in a term policy and exchange that term policy for a whole life policy. We're not going to get into the details here of how that works, but I just want to say this. You have to be careful about tax consequences when you do this. There are rules that apply to exchanging policies, particularly when you're talking about term policies and whole life policies, universal life policies, and annuities. And those are questions that will be raised on an exam as to how can you exchange these policies and what are the tax implications. Is it possible that you might have to pay income taxes on the cash value of these policies? So be very careful when you are exchanging policies. But what an exchange does is it provides flexibility to owners whose circumstances might change, and therefore the type of policy that they might need might change. Okay, so you might not be able to afford a whole life policy when you're young, so you have a term policy, and it has an exchange of policy provision in it which allows you 10 years down the road when you're doing better and financially, and you can afford to pay a whole life premium, then you might convert your term policy into a whole life policy. Okay? All right, and of course, as I've said many times, anytime you make changes in a policy, premiums will be adjusted, increased or decreased, depending on the nature of the changes that you make. Nothing is free. All right. There are not many exclusions, items that would keep an insurance company from paying a death benefit. There are not many exclusions with life insurance policies. Okay. So we've talked about the suicide waiver, and again, it's for 2 years. So you have to, the insurance company gets 2 years, and after 2 years, they cannot refuse to pay a death benefit because of suicide. And insurers might put in a war clause. If you are in the military and you go to war and you're killed, an insurance policy might have a war clause in it that is an exclusion. And so military people have access to custom designated policies that they secure when they enter into the military. Okay? Let's see. All right, if you're a pilot, you better check with your insurance agent and make sure they understand that you're a pilot, and make sure that that issue is addressed. If you are a rock climber, any hazardous hobbies that you might have, you need to bring this up with your insurance agent to make sure that they are addressed properly, because you would not want to be under the impression that your policy covers you. You go climb Mount Everest, you die, and then your family is excluded from the death benefit. So you better make sure that your insurance agent and the company knows what you're up to in terms of your hobbies. All right. Your options with regard to paying the premium. Of course, the insurance companies are going to make this as easy as possible for you to do. You can pay upfront annually, you can pay semi-annually, you can pay quarterly, or you can pay monthly. And one thing you have to look out for when you pay more than one time per year is to watch out for expensive financing charges. So it may cost you $1,000 to have a $1 million policy. Okay, you pay $1,000 up front each year, but you might have to pay, if you want to pay it on a monthly basis, it could cost you about $100 a month. Okay, that's $1,200. That's a $200 financing charge on a $1,000 loan. That's a 20% annual rate. So be very careful with paying expensive financing charges. All right. Okay, a life insurance policy is freely assignable to another party. So what does that mean, assignable? Okay? Assignable means that you can turn over ownership. Now, there's a difference between owning the policy and being the beneficiary. Okay? So in this case, you own the policy and you give the policy to someone else. That is assigning the policy, and you can do that as the owner. Under an absolute, so there are two types of assignment. There's absolute and collateral. Under an absolute assignment, okay, all ownership rights are transferred to a new owner. Okay? So a policy, now this is important, particularly important when there is a cash value or a surrender value associated with a whole life or universal life policy. There is value there. It's worth money. So if you assign that policy to someone, you are giving them the cash value. Now you may also be, well, you will most certainly be giving them the responsibility to pay the premium, to continue to pay the premium, unless you're giving them the policy and telling them go ahead and surrender the policy at any time. But if they want the policy to remain in force, then they would have to pay the premium unless you're willing to pay the premium for them. Okay? Okay, so this happens a lot when someone gives a policy to a church or some type of charitable or educational institution. You're saying, I am making a gift to you of this policy. You get it's similar to making it the institution a beneficiary. You get the value of the policy. Okay. So I mentioned there was also this thing called a collateral assignment, and this is when the policy owner will temporarily assign a life insurance policy to a creditor, a lender. So what they're saying is you can use the policy as collateral. Okay? So I'm taking out a loan, and the lender might not feel comfortable with my ability to pay back the loan. So what I do is I say, hey, I've got a $1 million policy, whole life policy. It's got a $300,000 cash value. So I am going to, and I'm taking out a $200,000 loan from you. So what I'm going to do is I'm going to assign my insurance policy to you as collateral, and in the event of my death, the creditor will get $200,000, the amount of the loan. Let's say when I die, the loan outstanding is $200,000. It's a $1 million death benefit. The creditor will get paid $200,000 by the insurance company, and then the family would get the other $800,000, or whoever the beneficiary is. Okay, so this is called a collateral assignment, and once the loan is paid off, then that assignment expires and goes back 100% to the owner of the policy. All right, now this is something that you hear agents talk about a lot: policy loan provisions, the ability to borrow from the cash value of your policy. Okay? So there are two things you can do with the policy. One is you can surrender it. If you need cash, you can surrender it. Okay? If you surrender a policy, then the death benefit is no longer in force. Okay? And if you surrender the policy, take the money, use the money, and then everything works out, and you decide, hey, I need to be insured, then you have to go back and have another health exam, and you have to be rated for your age again, and you have to pay expenses, your commissions up front again, and you go through the 2-year insurance clause, and you go through I think it's a 3-year, maybe it's a 2-year, can't remember. I think it's 2-year incontestability clause. That kicks in again, so that's a problem. So often surrendering your policy is not a real good way to access cash. It's not as good in many ways as simply borrowing from the cash value. Okay? So there's a process that you go through. There's paperwork that you have to submit to the insurance company, and you have to pay interest on the loan, okay? And the interest is paid to the insurance company. You are not paying interest to yourself like you are if you borrow against your 401k. If you borrow from the cash value of your 401k, you have to pay it back and you're paying interest to yourself. But if you borrow from a life insurance policy, from the surrender value or the cash value of the life insurance policy, you are paying interest to the insurance company, not to you, okay? So, let's see, it goes to the insurer, not to the insured. That's very important. And the policy could lapse if the policy owner does not repay a loan. So, when you borrow money from an insurance policy, it is a much less structured payback term. You have a lot more flexibility with regard to paying it back, but you have to get on a regular repayment schedule, okay? And if the amount that you borrow exceeds the cash value, then your policy could lapse, okay? And if you die, okay, and you have an outstanding loan balance out there, that outstanding loan balance is subtracted from the death benefit that is paid out. All right. All right, another cost of borrowing from your policy you have to be careful of is that the insurance company might lower or eliminate the credited interest that is paid on the accumulated value and or the dividends that are paid into the policy if it's a participating policy. So that's something to check on. Hey, Mr. Agent or Mrs. Agent, if I borrow against my cash value, what's my interest rate that I'll pay on it? Tell me how I have to repay it, and tell me if there are any consequences, any reduction to dividends or credited interest while the loan is outstanding. That's important, okay? All right, so why do people do it? Well, again, as I said, there's flexible repayment terms. You don't go through a credit check, okay? There is a very flexible repayment schedule, unlike with a bank, okay? But as I said, one of the downsides is the death benefit is reduced by the amount of any outstanding loan. All right. So there's another provision in policies that are pretty common, and that is the automatic premium loan provision. And so if your policy premium is late, then the premium is automatically borrowed from the policy to keep the policy in force, okay? So that's a good thing. If you forget, you get tied up, for some reason you don't pay the premium, if you have an automatic loan provision, then then the premium is paid out of the cash value. But you have to pay that back, or it will be permanently reduced from your cash value. All right. Okay, receiving dividends from the company. Several options with regard to what to do with dividends. So, if a policy pays dividends, this is different, we've talked about it before, this is different from owning the stock of a publicly traded insurance company. That means the stock might pay dividends. But this is not owning the stock, this is owning a policy and receiving a dividend as a benefit of owning a policy. Then it is called a participating policy. If the policy does not pay dividends, it's called a non-participating policy. Okay? Both stock companies and mutual companies can issue participating policies. Mutual companies are better known for issuing participating policies. Okay? So where do dividends come from? Well, they come from the profits and cash flow generated by an insurance company. And so how does an insurance company generate profit? Okay? Well, first, their actual mortality the deaths that they actually experience for a period of time are lower than what they expected, and so their cash flow is stronger. They're not paying out as much in the way of death benefits. Maybe they have done very well with their investments, and their investment earnings exceed what they expect, and they have additional cash flow. And then lastly, they do a really good job of managing their operating expenses, their staff expenses, and that's a source of cash flow and profit. So from these three areas, a company generates the cash flow and profits that they use to pay dividends. All right. So dividends are usually paid after a policy has been enforced for a specified period of time. So that's a question to ask your insurance agent. If I buy this policy, when does it start paying dividends? And remember, dividends paid on a participating policy are not taxable income. They are considered to be a return of your premium, okay? But you got to check that. When will I start receiving dividends? Okay? Now, how do you take dividends? What are your options? First, hey, send me the cash. Send me a check. My $1 million policy pays a $100 dividend each year. Send it to me. I'm going to spend it. Okay? How about keep the cash but reduce my premium due by the amount of the dividend? You can do that. Okay? How about keep the dividend and let it accumulate or earn an interest rate? Okay? And this amount can be withdrawn later, borrowed later, or it can be added to the face amount of your death benefit. Okay? So there are different ways you can handle your dividends. The dividend you receive, as I said, is not taxable. It's a return of premium. If it accumulates, then the dividend is not taxable, but the insurance company is going to keep a record of how much the dividends are, and they're going to pay you interest. The interest on your dividends is taxable, but that's probably not going to amount to a whole lot of money, but it could over a long period of time. Okay? Then there's this option. It's called paid up. You can purchase a small amount of a paid up whole life policy. So how does that work? Purchasing a small amount of a paid up whole life policy. Let's say that you get a $50 dividend from your insurance policy. The insurance company will buy a death benefit. In this case, $50 will buy $200 of paid up life. So what that means is your death benefit will go up by $200, and you won't ever have to pay any additional premium for that $200. So you might have a $1 million death benefit, but you use the $50 dividend. Instead of taking the cash, instead of reducing the premium, you say, do me a favor, take every dividend and start buying more paid up insurance. So if you do that on a regular basis, you could